So sources of financing, there are two types of sources. So the first one is short term and the second one is long term. So the differences between short term and long term, short term, the financial commitment will be less than a year, and long term, the financial commitment will be more than 1 year. So that is the differences between short term and long term. So at the end of this topic, it is expected from the student to be able to define the short-term financing, determine the key features of bond, calculate the bond valuation, able to measuring the yield of the bond, able to differentiate between the common share and preferred shares, also able to compute the share valuation. So sources of funds, it can comes from the borrowings and also capital. All right, so capital, it comes from the owner. However, for borrowing, it can comes from the bank. So borrowings can capital, it can be short-term debt and also long-term debt. Capital, it can be common shares and also preferred shares. All right, so common shares, it can comes from the retained earnings or the issuance of new shares. So this is the sources of financing. All right, sources of financing, it can comes from the borrowings and capital. So basically borrowing and capital, it's a structure of a business. It's a capital structure of business. Capital structure of business is a mix of capital and borrowings. So actually it is the sources to raise up the funds. So let us go to short-term financing first. So what is the meaning short-term financing? Short-term financing is a short-term obligation that is expected to mature in 1 year or it is less. And it is required to support a large portion of the firm's current asset. All right. So it is easier compared to long-term, and usually the cost of payment, the cost of the financing, it is a bit lower and it matches need for short-term assets. For example, inventory. Okay, for inventory, whenever you receive the inventory, it is already the short-term financing. Why I said so? Because of whenever you receive inventory from the supplier, you will do this kind of trading in credit. So that supplier become the spontaneous liabilities, or we call them as the credit to you. So you come up with spontaneous financing. So it is one of the short-term financing, because this inventory, whenever you get this inventory, you have to pay your supplier as soon as possible. All right, so it is also considered as short-term financing. So short-term financing may be used to meet the seasonal and temporary fluctuations of the business. All right, and also it is used to control the long-term needs. All right. So the first one is trade credit. Trade credit is referred to account payable. As I said earlier, as the example is the example of spontaneous liabilities is the supplier. Whenever you receive inventory, you make the transaction in credit. All right. So receiving the inventory itself is the spontaneous liability. So it refers to the account payable. You do the trade credit. All right, so it is the most flexible sources of financing. So business and suppliers will grant the trade credit on the sales of their goods and services. So that will arise from credit sales. All right, and it is recorded as account receivable by the seller. So the seller will record you as account receivable, but you yourself will record the account payable as the supplier. You record in your account as account payable because they are your supplier. So the supplier's credit term, usually they will offer discount for early payment. So the buyer will forgo the discount if they not grab the opportunity of the discount. So example of trade credit is 210 net 30. So in trade credit, we need to know what is the cost that we have to uh, pay because of foregoing the cash discount. So example like this. The meaning of this trade credit, is 2% discount will be given if the client or the customer able to pay within the 10 days. Okay, so 2% discount will be given to a client if the client able to pay within the 10 days. However, if the client not able to pay within the 10 days, the client must settle the amount within the 30 days. Okay, so the discount period will be 10 days. So this is discount period. And this is the credit period. Okay, so that is the meaning of trade credit, the credit term. So you have to understand, whenever you deal with supplier, the supplier give you this kind of trade credit, you have to understand this. So if you're not able to pay within 10 days, it means that you have to pay in full. For example, the amount of the payment is 100 ringgit. Okay, so it is 100 ringgit. So if you're able to pay within 10 days, you only need to pay 89 ringgit. However, if you're not able to pay within 10 days, you need to pay 100 ringgit. Alright, so that is the meaning of trade credit. Trade credit is referring to the account payable. It's a spontaneous account payable. It is spontaneous of liabilities. So next is bank credit. So bank credit is referred to the borrowings from bank. Okay, so commercial banks are the major sources of unsecured short-term credit. So it involves credit agreements and the transaction loan with the maturity period of 1 year or less. So rates of the interest will depend on the credit worthiness and risk of the borrower, and the borrower will be required to maintain a minimum balance, okay, in the bank throughout the period of loan. Minimum balance means that it's referred to the compensating balance. Okay, for example, 10% to 20%. So for example, you apply loan from Afin, for example. You apply loan from Afin, and Afin give you a requirement of 10% compensating balance. So if you already have money in Afin Bank, then it's okay. However, if you do not have money in Afin Bank, you need to open up account in Afin. And then, for example, you apply loan with the amount of 100,000. Okay, the compensating balance required is 10%. So 10% from 100K is equal to 10,000. So the only amount that you can withdraw is 90,000. Even though your loan is 100,000, but because of the compensating balance requirement, you're not able to withdraw all money. You have to maintain a certain amount in the account. So this money, we call this as compensating balance. Okay. So commercial banks often require borrowers to clean up their short-term loans for 30 to 45-day period during a year. So that because it's allowing them to be free of any bank debt for that time. All right. So this is to ensure that the borrowers are not using the short-term bank credit to finance part of their permanent needs. Permanent needs like rental, because this bank credit, it is specifically for fluctuations of the cash needed, not to maintain the not to maintain the fixed fixed expenses of the business. For example, paying salaries. So this kind of the permanent needs, bank will not allow to use the borrowings from bank to pay for any permanent needs. Example like rental and salaries lah. Bank credit can be allowed to give to the borrower if the borrower want to expand the business. So they see that there is a growth in the business. So bank will grant the credit to the corporations. So interest may be calculated as a simple interest or as a discount interest. So it can be either simple interest or discount interest. And the type of interest charge will be determined by the effective cost of a bank loan. So simple interest means that whenever the loan is given an interest, that interest will be interest expense later on. Okay, so that is simple interest. Discount interest means that you know the interest, you have to deduct the interest payment first before you receive the money. So for example, the amount of loan is equal to 100,000. All right. So the interest is 4%. Example like this. The interest is 4%. So 4% is equal to 4,000. So simple interest, if you are charged for simple interest, the loan of 100,000, you will receive in full amount, 100,000. However, for discount interest, you have to deduct the interest first. So the amount received will be 96,000. Instead of 100,000, you only receive 96,000 ringgit because you minus the interest payment before you receive the money. You get what I mean? So that's how the conduct of bank credit.
Madam,
Yes,
when do they offer this discount interest actually?
it depends on the rules and regulation of the bank that you want to apply for the borrowings.
Okay, madam.
All right. So example of bank credit, there are simple interest, only simple interest. So you've been offered the borrowings and you are charged on the simple interest. So that is simple interest. Second is discount interest. So discount interest is this discount interest lah. Third is simple interest with compensating balance. And the third one is discount interest with the compensating balance. So simple interest, you will receive all the all the borrowing in full amount. All right, the amount received will be full. Discount interest, you will receive the amount of loan after you deduct the interest payment. Okay, the amount received is equal to loan minus the interest payment. The third example, the amount received is equal to loan minus compensating balance. Compensating balance requirement. The third example, loan, the amount received is equal to loan minus interest payment, then minus the compensating balance. And so basically, the fourth example, the amount received will be the lowest amount, will be the lowest amount to receive compared to the first one. Because the first one, when you are charged in simple interest, only simple interest, you will receive all the money as per borrowed amount. Now, compared to the fourth example, your amount received, you need to deduct the interest payment first. You need to minus the compensating balance first. So basically, the amount received will be the lowest amount to receive, right? So whenever you know all these examples, the most important that you need to know what is the amount of earning of effective annual rate. All right, the effective annual rate. So for each of the examples of the bank credit, it will affect the effective annual rate. So the formula of effective annual rate is interest divided with the amount received. Because of the amount received is different, so that the effective annual rate also will be different. So let us go to simple interest first. So example given to you, Sharina wished to borrow 20,000. So this is the borrowed amount. The bank offers a simple interest loan at 14% per annum. So calculate the effective annual interest cost for this loan. So interest is 14% multiplied with 20,000. So it's equal to 2,800. Amount received, Sharina will receive all the amount of the borrowings. So she will receive all money lah. So 2,800 divided with 20, so it's equal to 14%. I think because this is simple interest. Let us look at this is another exercise. You may try this. Let us look at discount interest. So what happened of the effective annual rate if the interest need to be discounted? So interest payment is 2,800. So the amount received will be 17,200. Why? Because we have to minus the interest. 20,000 minus the interest. So 20,000 minus 2,800. So it's equal to 17,200. So the effective annual rate, now it increased to 16.28%. All right. 2,800 divide 17,200, then the answer is 0.1628 multiplied by 100 because you want the answer in percentage. So just multiply by 100. So the answer is 16.28. Right? So far, are you following?
Yes, madam.
All right. So let us move to simple interest with compensating balance. So simple interest with compensating balance, still effective annual rate. The formula for effective annual rate is interest divide with amount received. So now the part that change is the amount received. Okay. So in discount interest, the amount received you have to minus interest. Now, in simple interest with compensating balance, amount received you have to minus with compensating balance. So the question says here that the compensating balance is 20% of the loan amount. So 20% of the loan amount is equal to 4,000. Okay, 20%, so 0.2 multiply with 20,000, so it's equal to 4,000. All right, so amount received is equal to 20, amount received is 16,000 because 20,000 minus 4,000, so it's equal to 16,000. So effective annual rate is 2,800 divided by 16,000. So the answer is 0.175. So multiply by 100, it is 17.5%. All right. Okay. All right. So now let us go to the fourth example, which is which is the discount interest with compensating balance. So the same question, but the situation is discount interest with compensating balance. So compensating balance is 20%, the interest is 40%. So the amount received will be different because, all right, the amount received will be different. Because the amount borrowed is 20,000 minus the interest because it is discount interest, and then minus the compensating balance. So now the amount received is only 13,200. All right, so interest still the same, 2,800 divide with amount received, 13,200. So now the answer is 0.2121. So multiply by 100, so the answer is 21.21%. All right. So these are the differences lah between the four example of bank credit ataupun bank loan. So the most important that you want to know is the effective annual rate. So even though the interest charge is 14%, 14% is high actually. Let's say it's just 14%. But whenever you take into consideration on the interest as well as the compensating balance, the rate actually is higher. That is how the financial analyst will analyze whether to take the offer of the loan or to reject the loan offer. Okay, by looking at the effective annual rate. All right.